Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Well, good day, y'all. Ira Epstein of Linn Associates with your weekend edition of your grain review. And this is for Friday, the 7th of September, 2018. And the markets are closed. You can see how we finished off here. And one of the big things we're all looking for are trade deals. It appears the president wants to ratchet up even more tariffs on China than the $200 billion he now can do at any point in time. Today, threatened them with $267 billion over that amount, which means literally every product that we get from them, we would be taxed on. That's one way to look at it. Then he's saying to Japan, it's your turn. We negotiate. If not, you see what goes on. And then we've got Canada still weighing. For the farmer, it's certainly not good. Now, as we keep going on in the season, the question is wet weather. The question is early harvest probably being impacted in the Midwest by that. When we take a look at a monthly bar chart, you still have a market that's coming down and breaking back. You're only 22 cents off these lows. If the market can hold this whole break through the harvest time, well, I think people would say you've got a long-term bottom in. Conversely, take that out, you might be ratcheting down to that 750 area, another 50, 60 cents, something you have to be concerned about. On the weekly chart, you had a big break to 810.5, spent some time rallying, and all of a sudden, it's fading away. You're back to a pattern of lower highs, lower lows, bearish. You'd have to take out 896 on the weekly chart to negate this pattern. When you come to moving averages, you're under all the key moving averages. Let's just put up the 100 here and the 18-week there. When I come to Bollinger Bands, the next support zone is the 761. So if you wonder where I came in with that 750 zone, that is what I'm looking at if it makes a run for the lower Bollinger Band. And in momentum is measured by the slow stochastic, still pointing down. So I see nothing on this chart that has turned the market in any way. We are getting a bounce in the soy meal on the weekly chart. And on the daily chart, you went up to the 18-day average of closes. But on this chart, the closer resistance is 328.5, the 100-week. Momentum hasn't budged. It's still bearish. You have a pattern of a higher high and lower low. So this break from $342.60 to $3 or so, it's held, and the market's trying to come back a little bit. Soybean oil is freshly getting more bearish. Yeah, today. Sort of put the damper on this thing. You've got lower highs. Now, this week's low took out last week's low. So until you take out this week's high of 28.58, I'm definitely in the bear camp looking to see if this market can make a run through the most current lows and make a run for the lower Bollinger Band. Where would I be wrong? Well, I think if you took out this week's high, I'd have to rethink the whole pattern. So that is the number, 28.58 I'd be looking at. In the corn market, you have a contra, not trend, but it's the word, because you've got a pattern of higher lows and higher highs, different than we're looking at elsewhere. You've got a pretty strong resistance point coming in between 361 3/4, the green 100-week average, and 365, let's call it and a half, the 18-week average. Momentum is flat to trying to turn up a little bit, and you're seeing that in prices. Take out 340, and you reinstate the pattern of lower highs, lower lows, and you put into play 326. Continue the rally here, and I'd look for that 361 3/4 to be the resistance. In the wheat market, as big as the break has been on the daily chart, you still haven't gone back on the weekly and taken out this 469 3/4. As you can see, 486 was the low of the week, and you closed literally right off of it. But this is still a pattern of higher lows, higher highs. Momentum is down, bias is down. A lot of things fighting itself on this chart, nothing in sync. In the cocoa market, the longer-term play has confirmed bearishness again. This whole rally still has a pattern of lower highs, lower lows, momentum kicked up and out of being oversold. Now it's back into the 40s, and the market, until it takes out 23.91, maintains that pattern. Now, if you take out 23.91 and were to get over the weekly average of 23.98, I would flip-flop and say the market's turning bullish. So that's where the bears, I think, have to defend the market. In the sugar market, we're getting a big bounce that's more due than not. Now, when I say big, you've gone from 991 back up to 1101. Can we make a run for the 18-week average? We could. If the market does that, and I say that because momentum is turning up, 1113 will be the number to watch. It would break this pattern that we've had since right here before June of lower highs, lower lows on the weekly chart. In the coffee, when you look at the daily chart, you get one picture. This chart is just maintaining its bearishness. This market is riding the lower Bollinger Band with momentum locked into a bear pattern, lower highs, lower lows. To break the downtrend, the market's got to get over 102.20. That would break it. In the cotton market, you reinstated the bear part of the market this week. Lower highs, lower lows. So you'd have to take out 83.98 on the weekly chart to reverse that, or you couldn't even reverse it. You could negate the bear trend, and momentum is down and the bias is down. The bears regained control of this market. In the cattle market, this rally could carry back up to the upper Bollinger Band, but I'm watching the tightness of these bands develop in sideways action more than anything else. The chart is bullish, the momentum is bullish, and the bias is bullish, all three. In the hog market, we have a pattern of what? Lower highs, lower lows. To negate that, you've got to take out the 59.50 zone. The hope and prayer had been that if China got a deal with the U.S., that China, because of the African swine flu, would take some U.S. pork. Remember, they do own, I think it's Smithfield here, so you've got to keep your eye on what goes on with all that. On the other hand, the chart action is still bearish. The daily chart's one thing. The weekly chart needs to take out 59.50 to tell you something else is brewing. I want to remind you, we write about all this, and if you're a grain trader, you should absolutely love what this firm does. We've already put out today, we put out our soybean and our corn production numbers for the upcoming report this week in the crop production. We'll do it, and a lot of people look at this firm. They're well known in the grain market, so they look at our numbers. We represent a lot of hedge firms, and we give you trade ideas going into it, taking a look at what's going on, and rationale as to what the hedgers, the commercial users, the speculators are doing in both futures and options on futures. How do you get to see what our clients see for a short while? Well, we offer a free trial. You can try it out by giving us a call, going to our website. You'll see a carousel of free offers, and you can always click right up here, and when you do so, it'll take you right to that page. Choose away, and we'll get it to your mailbox. I'm Ira Epstein. You have a great weekend. I'll see everyone Monday.